Here's your money briefing for Monday, April 10th. I'm J.R. Whalen for the Wall Street Journal. We're almost done with this year's tax filing season, but here's something every taxpayer should know as they plan for next year. Tips for reducing their tax bill. Wall Street Journal personal finance reporter Ashlea Ebeling joins me now. Hey, Ashlea, thanks for being here.
Nice to be here.
So, Ashlea, the average tax bill has been steadily climbing the past several years. It's reached nearly $8,000. Why are tax bills on the rise?
This year, people are more likely to get a lower refund or actually a tax bill because of the expiration of pandemic enhancements to the child tax credit and the dependent care tax credit and some other tax breaks too. So there were also large capital gain distributions on mutual funds late last year, and that caught a lot of taxpayers by surprise. If they didn't withhold and put in estimated payments correctly, then they're going to be seeing these big tax bills this tax season.
Now, how significant are the expiration of the tax credits that you mentioned?
Well, it can actually make thousands of dollars difference on your final tax bill. For example, just the child tax credit, one family I talked to, they had $6,600 in a tax credit last year, and then this year it's just $4,000. So that means a big difference in the bottom line when they see their balance due.
All right, so let's talk about how people can avoid a big surprise in their tax bill going forward. What should people look for in their paycheck?
So you can avoid a balance due by adjusting your tax withholding in your paycheck, or you can make estimated tax payments, but you need to do that well before tax time. And this particularly applies if you get a bonus and your employer doesn't withhold enough taxes, or if you sell stocks at a gain without offsetting losses. It's a big deal for anyone with self-employment income. They need to be making in estimated tax payments throughout the year. And even someone who takes money out of the retirement account and doesn't withhold the right amount, they can get stuck with a surprise bill.
Yeah, this sounds like a lot of math involved. How would somebody know how much to increase the amount of taxes being withheld in their paycheck?
So the point is, don't just guess. I spoke with an enrolled agent, a tax pro in Homedale, New Jersey, who said one of his New York-based clients who took money out of his IRA to help out his parents last year, he just checked off 20% for withholding, but he's actually in the 35% bracket. So between that mistake and an under-withheld bonus, he owed about $5,000 at tax time. So it's really important to check your withholding during the year to make sure it matches your tax bracket, depending on what your income is as your income comes in throughout the year. And one way to do that is to do periodic checks, especially if you have these events like a bonus, that type of thing, or IRA withdrawals. And you can check it throughout the year at irs.gov.
Now, the filing deadline this year is April 18th, but we often hear of extensions because of special circumstances, and they often have to do with natural disasters. What happens to people who live in declared disaster areas?
So this year, unfortunately, has been a really bad year for storms. You have to be on the federally declared disaster area list, your county, to actually qualify for the relief. But if you are on that list, you might have until October 16th, 2023 to file and pay your 2022 taxes. So that's residents in all but 3 counties in California, all of Los Angeles County, for example. Even if you weren't personally affected by the storm, you have until October 16th to file and pay. Same goes for some counties in Alabama and Georgia. And taxpayers in certain counties in New York have until May 15th, and taxpayers in certain counties in Arkansas and Mississippi have until July 31st. So again, go to irs.gov and check for the IRS disaster tax relief list.
And so what some of these people have been through, this extra time could really be useful for them.
Right. Later due dates mean taxpayers can park cash in a money market fund or a CD to earn interest and pay later. It also helps those who can use the extra time just to get their money together.
Now, what if people outside of disaster zones simply can't pay their tax bill?
So tax advisors suggest asking friends and family for a loan before resorting to putting a balance due on a credit card with high interest or turning to the IRS. It's super important to remember as soon as your payment due date passes and the tax bill goes unpaid, the IRS begins charging interest and penalties. And they're pretty high. The current interest rate is 7%. The penalty for failure to pay is 0.5% of the unpaid balance each month, or 6% a year, up to a maximum of 25%.
Now, Ashlea, does the IRS offer some sort of payment plan?
Yes, it does. But keep in mind that even if you're on the payment plan, you're still paying interest and penalties. The penalty does get reduced for taxpayers who enter into an IRS-approved payment plan. It drops to 0.25% a month or 3% a year. But even then, you're still paying 10% on an annual basis. One thing to keep in mind is the failure to pay penalty can be waived entirely for taxpayers with no late filing or late payment penalties for 3 years.
And what if you can't pay all that you owe, even over time?
So there are more options. If you can't pay all that you owe, there's a partial payment plan, or kind of the last resort. The taxpayer can secure what's called an offer in compromise, and the offer sometimes allows taxpayers to settle tax debt for less than what they owe. They require substantial financial disclosures and can take 6 to 12 months for the IRS to consider.
All right, that's Wall Street Journal personal finance reporter Ashlea Ebeling. Ashlea, thanks so much for being with us.
Thanks for having me.
And that's your Money Briefing. I'm J.R. Whalen for the Wall Street Journal.